Hey everyone, Chaps here, and today's video is a follow-on to the previous discussion about Roth versus traditional or pre-tax 401ks and IRAs and who benefits the most from each. If you missed that discussion, you can find it linked down below. Today, we're going into the math. We're going to take a more granular look at who benefits most from Roth and who benefits most from traditional or pre-tax. It's believed that pre-tax benefits higher earners and people later in their career. Why is that though? Well, to explain it, I'm going to be doing some math here. This is all going to be from the spreadsheet that I'll be showing you here in a minute, and I'll have that link down below if you want to download the spreadsheet and mess around with it. Also be warned, there are a lot of numbers coming up. I'm going to be walking through things, but if math isn't your forte, you can ignore a lot of the numbers I'm going to do early on in the video. Once we get through the calculation, I'll explain the end result, and it's actually quite simple to understand. Okay, let's do this. Let's take someone who's in the 22% tax bracket contributing $10,000 a year to their 401k. I'll also throw in a 3% state tax. For now, we'll assume an 8% annual return and that they'll retire in 30 years. If they were to contribute to a Roth 401k, they would put in $10,000, which has already been taxed. At the 8% rate for 30 years, the investment would grow to just over 10x what they initially put in, and it would now be worth $100,626.57. This is a Roth account, so all of that growth was tax-free, so if they were to take that money out, they'd still have that whole $100,000-ish number. That was easy, but what happens with pre-tax? Well, if they had put that same $10,000 into pre-tax, they'd actually be saving money in the short term. The $10,000 hasn't been taxed yet. The taxation would have occurred at their marginal federal tax rate, which we established was 22% plus the 3% state tax, so totaling to 25% tax. Therefore, by the end of the year, they'll have an extra $2,500 left to spend. The wise thing to do with that additional income would be to invest it, so let's assume that happens. Using the same 8% for 30 years, your investment now becomes $100,626.57 in your pre-tax 401k account. Yep, exactly the same as Roth. And that $2,500 that you invested now becomes $25,156.64 in your personal investment account. This totals to $125,783.21. Clearly, that is more than the about 100k-ish that is in the Roth account. But this money hasn't been taxed yet. Let's start with taxing the personal investments. Only the gains on this are taxed, i.e. the 25k minus the initial 2.5k. So $22,656.64 is taxable. You'll have to estimate what your capital gains tax will be in retirement, but let's use the middle ground 15% for long-term capital gains. That means you're going to owe $3,398.50 in taxes. Okay, so that's taxed, but what about our 401k money? Well, here instead of taxing it, I'm going to do some algebra. I wanted to figure out what the tax rate would be to cause my pre-tax and Roth options to break even. I'm not going to explain the algebra here, you can see it in the spreadsheet, but in this case, it turns out that that tax rate is 21.62%. That means that we're going to owe $21,758.15 on our 401k withdrawal. If you subtract this investment and the 401k tax from our taxable income, we're now left with, you guessed it, $100,626.57, the same as the Roth. That's the whole point of that algebra I did. It's let's calculate that tax rate so that Roth and pre-tax come out dead even with each other. So let's jump over to the spreadsheet. Here's our inputs up top, then we calculate the Roth value on the left, and we see our final after-tax earnings. On the right, we have our pre-tax and investment savings, we tax our capital gains, and we get that 21.62 effective tax rate. Now, if all of that math was too much for you, don't worry, just focus on that 21.62%. Essentially, the higher this number, the more of a benefit we're going to see from the pre-tax 401k. I'll explain all of that later, but for now, let's see how changing our inputs will change this number. If we change the 401k contribution, it's clear that it actually doesn't change the result. Changing your current tax bracket has a pretty significant impact. Basically, the higher your tax bracket, the larger that break-even tax becomes, i.e. the higher your tax bracket, the more benefit you see from pre-tax. What about the annual rate of return? Decreasing this will provide a larger benefit for pre-tax. And lastly, we have years until retirement. Decreasing this will also provide a larger benefit for pre-tax. Oh, and I guess I'll show the capital gains tax input over here. It's at 15% now. Any lower and we'll see a larger benefit from pre-tax. And look what happens if I make it 0. The break-even effective tax actually equals our current tax rate. Well, that's the federal plus state tax rate. Okay, so now we have a general understanding of how that break-even point is calculated and how our inputs affect it. But what is the value actually showing? Well, at the top, we specify our marginal tax rate. That is the amount that you're taxed for every additional dollar that you earn, or the amount that you aren't taxed for every dollar that you don't earn. If you make $100,000, currently your federal marginal tax rate is 24%. For every $1 you earn, you owe 24 cents more in taxes. For every $1 less you earn, you owe 24 cents less in taxes. That 21.62% is an effective tax rate. That is, it's the total you paid in taxes divided by your gross earnings. Or in this case, it's actually the total that you'd need to pay on taxes from your pre-tax money divided by the total value of your pre-tax money. For these calculations, we're only really concerned with that pre-tax portion. We're not really concerned with the untaxable dollars. I mentioned that this calculated number is an effective tax rate in order to break even. If your actual effective tax rate is lower, then pre-tax is going to be better. If your actual effective tax rate is higher, then Roth is going to be better. But how do we know what our actual tax rate is? And this is another thing, you can't predict the future, so you don't know. But what we can do is estimate how much we're going to be taking out of our accounts in retirement, and we can, for now, let's assume the current tax rates stay the same. So let's look at some possibilities here. We'll start with this table that shows the amount withdrawn from your 401k. On the left, we see your annual taxable income allowance. That is, how much taxable income do you plan on having in a year? This can be from anything like Social Security, rollover IRA, the pre-tax 401k, including those required minimum distributions. Once you have an idea of how much taxable income you plan to have in retirement, you can determine how much of that is originating from your pre-tax 401k. If I expect $80K of taxable income and 50% comes from pre-tax 401k, I go down here and see that I'll be taking $40,000 out of my pre-tax 401k. Not really anything mind-blowing here, it's just a simple table. This next table was a bit of a pain to make, but it's the amount that you're being taxed on that withdrawal. It uses the total taxable income to determine your marginal tax rate. It then uses the amount withdrawn to determine how much you'd be paying in taxes. It uses your marginal rate and it works its way down. So you start at the highest bracket, and if you take out enough, a portion of that will come out of the next lowest bracket, and so on and so on. Oh, and note that I'm using the 2023 tax numbers here. It's simple enough to update the tax rates on their own. I included a single filer and married jointly as the two options on this spreadsheet right now. You can easily switch back and forth by changing the drop-down at the top of the sheet. With the example I've been going through, I go to $80K and 50% and find that my $40,000 withdrawn will cost me $4,800 in federal taxes. So now we know how much we're withdrawing and how much of that is being taxed. Going back to our equation from earlier, our effective tax rate is equal to the tax divided by withdrawals. And yeah, we're going to have to account for state tax here as well. I've got that added in. We now have the effective tax rate on our pre-tax 401k withdrawals. It's now easy enough to compare this to our break-even point, and we can clearly see when pre-tax is beneficial versus where Roth is beneficial. For example, going to $80K and then 50%, we see that the effective tax rate of our 401k withdrawals is 15%. Clearly, this is lower than the break-even point of 21.62%. Thus, in this case, contributing to a pre-tax 401k is more beneficial than a Roth 401k. As you pull more taxable income in retirement, it increases your effective tax bracket, hence Roth becoming better as your retirement costs increase. If a larger portion of your taxable income comes from a pre-tax source, then more of that income is spread across the various tax buckets. Hence, the right side of the chart is showing much more green. And there you have it. Yeah, it's a somewhat messy sheet, and I could have condensed it down significantly by not showing each step, but I figured that some people would like that granularity and showing each step put in there, so I left it in. Again, if you want to try the sheet out for yourself, it's linked down below. Download it, throw in your numbers, see what works best for you. I sent this to my family, but I haven't really run it by anyone else. I'm hoping it all makes sense, and I'm really hoping there's no glaring errors in it. But if you find an error, or if you have a question about this sheet, let me know. I can try and fix any errors or answer any questions. If all of this math is just too much for you, then the commonly accepted guidelines are good enough. If your tax bracket will be lower in retirement, use pre-tax. If your tax bracket will be higher in retirement, use Roth. This sheet is really intended for those in a middle ground or for people trying to optimize things. If you have any questions about how the sheet works or what the results mean, feel free to hit me up on Twitter or just leave a comment down below. If you enjoyed this or found it helpful, please like and consider subscribing. Also, if you have anyone that you know that is debating between this Roth and traditional thing, feel free to send the sheet over to them and it might help them out. Thanks for watching, everyone, and I'll catch you next time.